Best way of looking at successful wealth accumulation is that you tend to get rich really slowly and then you get rich very quickly after that. As you convert your human capital into financial capital, you then look into the concept of investing it into the equity markets to be able to build that wealth escalator.
Realistically, your biggest growth in wealth in your 20 to 30 is really your income. It's actually better off working really hard and growing your work income. And then you invest a portion of it every month.
For a long time was one of those that you try to squeeze as much as you can out of the small little portfolio that you have. Anything south of 100 is a waste of time. You don't realize that maybe it's better for you to go take the $200 and go for an endless amount of networking sessions in your industry.
Work smart, invest, and retire well.
Welcome back to Chills with TFC. I'm your host Reggie, aka your Chief Financial Coconut, and today I have been conquered by Chris's in the studio. Yes, it's Reggie versus 3 Chris. For all of you that don't know, I have taken a lot of effort to court this Chris to be the producer of the show. So maybe for our audience that don't know you yet, can you introduce yourself?
Hey
Did
guys,
you hear your story, right?
they heard my
Yeah,
story.
that's good. Check out the episode.
Yeah, so just a short one. So, hey guys, Chris, semi-retired 3 years back. So now I am producer at TFC. I also have a blog called retiredby50.me. So come check it out.
Okay, so what Chris are you? Because there's 3 Chris. On a normal day, I don't need you to clarify you're Chris what?
Chris How, H-O-W.
Okay, CH. Okay, today's episode he'll be C. C. Okay, and we are joined with 2 other Chris's, on an important topic. Yeah, for our audience that somehow don't quite know you yet, which is quite impossible. But yeah, just for the benefit of our new joiners, introduce yourself.
So my name is Chris Chong. I was an ex-chartered accountant in my corporate days, but now I'm more known as a personal finance YouTuber, as you all know, financial influencer. So I do run a YouTube channel. It's around 45,000 subscribers. I also do some social media work. Yeah. And in my other capacity, I'm also a business consultant for my other business, Solo Biz. So we kind of teach people tax planning, corporate structure, but very boring stuff, I know. But that was my accounting profession. So nowadays I try to live life, work less, live more, work optional, you call it. So in my previous few episodes with TFC, I was more on the fire team.
Yeah.
So now it's something very similar within that fire team.
Bro's done. Bro's done it. Alright, so now he's can say staying in the north, hiding away from everyone.
Oh, yeah.
Just doing his thing. But I was quite surprised that he was back in this whole accountant thing. But either way, we can talk about it later. Yes, and we are joined with our sniper, from the IPO circle. But today is not the IPO circle. Yes, Chris, introduce yourself.
Yeah, my name is Christopher Ng. I wear many hats. I teach the early retirement masterclass with Dr. Wealth. I teach law and data analytics in a polytechnic. And I have a YouTube channel and a blog known as Growing Your Tree of Prosperity.
Awesome, and he's our in-house sniper for the IPO circle. There are more things to come. Stay tuned for that. I know you guys love the episode. It might be spun off into a show of its own, right? By sheer volume. We'll see what happens. But more importantly, today's episode is about wealth accumulation strategies for busy professionals like yourself. I was inspired by quite a few posts recently where I saw people write about it. I said, oh yeah, actually there's a context here that we can discuss. And I think for us, we've all kind of been in this space for many years. Of course, Chris is 20 years right? So it's like a diminishing kind of situation here, So we thought it would be a good episode to discuss some of the leading things that people are talking about, and whether it works, put out our point of view, what works, what doesn't work, talk about some of the products that are out there today in the market, and just kind of put out our take to decipher from all the noise, right? Fair I think noise is a fair statement, right? Because everybody believes that whatever that they say is true huh?
And I guess it also helps that people like us, the financial influencers, we kind of distill what is better in some versus what is not as good, right? So there are too many products out there and we really need to distill that. And that's where the value of us bring here for this discussion today.
So what is a bad product?
What's a bad product? You're going to put me in the spot. But it's okay, I get it. Right, so a bad product is one where the value does not lie in the consumer. right? It benefits the platform or the company more than it benefits the consumer. And hiding behind jargons and hidden fees that we do not even know until like creators or TFC talk about it. So I think it's very important for us to have this platform. We are the middleman to translate all this corporate jargon, industry knowledge to layman language that you can understand.
Fair. Very good. See, YouTuber
Got
就是
rehearse
不一
one,
样.
got
Yeah,
rehearse
yeah.
one.
Hey, he don't rehearse, he does this every day, okay?
I do this every day.
But maybe just okay, so we've all been doing like some sort of a coverage, and we've invested ourselves, we've built our portfolio over the course of time. And I believe we have different strategies, over the course of time. So maybe just to lay the ground, right? Like maybe can just share your thoughts on like how you're seeing the landscape so far. From the ideas that are around or the solution providers that are around, just so everybody gets a bit of a sense of how we are looking at the wealth, management landscape here in Singapore.
I think that the investment landscape, there is too much emphasis on actually day trading and high turnover strategies, right, involving technical analysis, right? But when it comes to accumulation of wealth, the best way of looking at successful wealth accumulation is that you tend to get rich really slowly and then you get rich very quickly after that, right? You build up your human capital, right, which is the net present value of all your unearned income. And you can grow that, right? And you grow that by developing skills, learning how the world of finance works, right? And as you convert your human capital into financial capital, you then look into the concept of investing it into the equity markets to be able to build that wealth escalator. And I think as Singaporeans, there are many ways to build that wealth escalator. We have obviously the marriage BTO route is actually a very important source of wealth, right? Because real estate.
There is
right?
a whole discussion.
On that.
There's a season.
Yeah.
It's not a 5-minute spiel.
There is obviously another source of wealth known as your CPF, right? Where you grow your CPF, eventually converts into CPF Life and annuity like kind of savings. And now, increasingly, Singaporeans are seeing that our financial markets are alive and well again. And you can see that the equity markets is also creating that new wealth escalator within the stock market, right? So the fundamentals don't really change. You develop your human capital, you learn to save as much money as you can, and then you try to ride on these wealth escalators. I think that really brings out a very, very generic method of generating wealth, which I think a lot of people, they underestimate.
Fair. I really want to ask about the CPF thing, but let me just, stay, I want to follow the format. Because some people comment say, I just anyhow flow all the time.
Okay.
So it's one-to-one interview, okay lah. I can just, go with the flow, but we have a bit of a structure, okay?
Okay.
Yes. So, Chris Chong, yes. I call all of them Chris, they're all safe as Chris, but anyway, yes. What is your read on the landscape?
Okay, so I'm going to follow the TFC motto, and it's going to be work smart, invest, and retire well, because this is fundamentally the concept behind every financial well-being strategy or what. And everything else may be just noise, okay? I know that's a big statement to take, but hear me out. Okay, so here's the thing, right? In order to have the money to invest, you will first need to have income. And income comes from human capital, like what Christopher Ng just said, right? So working on your income, increasing the salary, go for the promotion, go for the next best paying industry, and then having a prudent financial spending habit. Not means having low spending and not spending on anything, but have a conscious spending plan. So that's the spending well part. Invest the rest means the difference. You want to increase the difference between what you're earning versus what you're spending. And that's what most people get wrong, because they try to see the investment part first, right? Okay, maybe not. But for more financially literate people, they focus too much on the investing part. They don't focus too much on the earning part or even the spending part. So they try to chase for the quick gains. This is why we see a lot of all these master classes, financial training, financial coaching kind of thing spring up in this bull market, because everything sounds very exciting, very sexy to get you to the destination faster and better than anyone else. And the truth is that the fundamentals have never changed. We are all trying to get rich slowly and steadily instead of chasing for that fast wealth. But right now we are in this bull market, and everyone is telling you they can get there faster than anyone could, right? So you are going to get bound to hear a lot of all these noises, which is what we are trying to cut off these distractions in our podcast today.
Yeah, but I think just so I equalize that thinking a little bit, right? It's not just the course providers, right? Everyone is riding on it.
Of
So
course.
your fund managers, your brokers, all your different platform providers that are within this category.
Yeah, YouTubers as well.
They are all trying to capture that space, right? So I mean, it's just everybody try to make it sound like they have the silver bullet, right? But I think if you just kind of wind back a little bit, you realize the fundamentals are there, and I think our audience broadly understands, right? But we will go into the strategies in a while after.
But you like it
opening-
or not, it's just business.
Yeah.
During
No,
bear
no.
market,
Yeah.
where can
How
you
to
sell
do business, right? Very hard to sell anything. Yeah. But anyway, hold your horses. Yeah. So any thoughts?
So I think what I really like about what Chris Chong mentioned earlier, realistically, your biggest growth in wealth in your 20 to 30 is really your income. So instead of trying to invest the little money that you have, the small little capital that you have, it's actually better off working really hard and growing your work income. And then you invest a portion of it every month.
That's why they all become busy professionals.
Yeah, but
that's
most
a premise of a BC professional.
But most of the people that when I speak to, the ones that actually chase after the high returns and all that, I think realistically it's just because they don't have a reasonable expectation. They want to think that they can be retired in 5-10 years when they don't have a lot of money, which just means that they end up taking a lot of risk, which has a higher probability of not being able to retire early.
No, fair. And just to add into the conversation, I was one of those people, right? Because I didn't hold a full-time job for a long time. I created a full-time job for myself. I'm very annoyed by it. But that's a different discussion. I do like some of the work that we do at TFC, but like as with any other normal work, right? Like you will have some parts that you like, some parts that you don't. So you're just trying to like manage this bit, right? So that's a different discussion. But I, for a long time, was one of those that you try to squeeze as much as you can out of the small little portfolio that you have, without realizing that actually, you just gonna randomly do a job. You could make a lot more than just sitting down there and trying to squeeze that little portfolio that you have for maximum value lah. Right, so I guess I've outgrown that, And,
I mean, even if you save up to 10K, how much optimization can you do?
Yeah. No, I think it's not even about 10. I think anything south of 100 is a waste of time. As in waste of time in the sense of optimizing and putting all your effort on it, right? Like really, if it's between like 100 to 300,000, right, you're probably better off. Most busy professionals make a median income of like what 8.2. I think that's a uni grad 8.2 a month, right? So you do that, you back test for 3 years, you keep a savings rate of 50%. If you
Uni-grad
can.
don't get 8.2 now. Later the employers cancel us.
No. University holding professionals. Okay, that means as long as you got a degree,
You work a few years.
I mean, all the people who got degree 一字排开, okay, the median one is about 8.2, I think. The last I recall from one of the MOM reports. Don't mark me on it, okay? But that is broadly it. So I think the message is that if you keep a saving rate at 50% over the course of 3 years, you will already make that 100 over 1,000, right? You can really save that 100 over 1,000 rather than you sit down there and like try to squeeze and take outsized risk strategies, in the portfolio lah. So I think that's the wisdom that I think for a lot of busy professionals, especially the younger ones, you should be aware because you are prime target for all the promotion, right?
Okay. But do you think that is a popular opinion or unpopular opinion?
I think that's an unpopular opinion. The popular opinion is start as young as possible.
Yes.
And
invest with whatever money
invest
you
in
have.
whatever you have. So this is the popular opinion that I have to take an opposite stance on, right? Because okay, this is my point of view. Okay, the underpinning idea of this opinion is that you become familiar.
Right.
You get a better sense of how things work. Okay, this one I can support. Not wrong. But the caveat here is that all of us have 24 hours a day, right? And the value of time is often mispriced, right? Especially when you are just starting out lah. Because to you it's like I work a job, my starting salary maybe 3,000-4,000, right? I think it's still for most people, unless you join investment banking or management associate or whatever, right? Most people will be like 3,000 or 4,000 a month. So you take based on that, you misprice the value of your time. So you don't realize that maybe all the hours spent trying to like,
invest $200 a month.
Yes, that's the context. And maybe it's better for you to go take the $200 and go for an endless amount of networking sessions in your industry, right? And you get so much more ROI in that sense, right? So I don't discount the fact that you start earlier, you learn more, yes, but I think the numbers don't add up when you have such a small portfolio and you're squeezing all your bandwidth and effort and all your time on that rather than maximizing your career lah. Yeah, from at least from my point of view lah.
I think it's not wrong to start investing. It's just that don't over-engineer the entire thing.
Yeah, and I will argue that it's a sales narrative lah. But that's a different, slightly different discussion. Any thoughts?
Actually, I take your opposite stance. I'm actually fairly old school here. Starting a brokerage as young as possible, it's probably beneficial for educational reasons, right? And if you were to buy a couple of blue chip stocks in Singapore, for example, right, you can visibly say that in Woodlands, I've got this building, it sort of belongs to me because it's ESRE.
I'm going to challenge that later. I'm going to challenge that later.
I mean, and
the one that pays 9%, is it?
ESR, yeah.
ESR pays 9%. Yeah. ESR.
And you could look at the banks and say that, you know, the people queuing up and all that, right? Some of that money goes to me. And it also develops your sensitivity to the business times and the news. And you would have a much bigger incentive to read The Economist, read Business Times. And it actually makes you more effective at work. And one of the things that really bugged me when I started my job, because I was an engineer, I wasn't an accountant, right? And within the first 2 weeks, the meeting is said that, you know, hey Chris, this server that you're buying, is it going to be capital or expense? I didn't know how to answer it. I didn't know what to say because I felt so ignorant. And actually that spurred me to start studying for the CFA. So I think it's not really about financial compounding or dividends, but your knowledge compounds and it generates dividends as well and lead to other areas in your life.
Fair, I don't disagree with that. But yes, Chris Chong.
First of all, most of the things that Chris Ng just said, I do fundamentally agree. Okay, so the points that I agree that knowledge compounds and it's better to start compounding knowledge as fast as possible. But is there a better way to compound that knowledge or not? Okay, so let's go back to the example of, let's say you are investing in this REIT, you know that this property, you have a partial ownership of it, okay, and it pays you like regular distributions, or some of you call it dividends for that matter. But the truth is that fundamentally, if you are going for an income investing strategy, trying to, you know, pick stocks and, you know, study a particular company, it is not a very good use of your time right now in that early phase, okay? Because everyone needs to have that learning curve, right? And yes, some people may say to start small. But if you're starting off picking stocks, it is not a very valid strategy at your point in time because you don't really have that macro view of economy of the world yet. And you only know that you own this part, 1 little building, okay? And that's all you focus in, you micro in everything. And you will kind of zoom out on everything else that's going to affect the macro economy, like interest rates, like what the Fed is doing, like what Trump is saying, or even the Straits of Hormuz closure. Okay, so what I always advocate on my channel is that you try to build a passive investing strategy first, okay? Broad market, diversified index funds. And then once you learn the ropes already, you start to, if you have the expertise and the interest to go and learn individual companies, then you go and zoom in micro. So it's from a macro to a micro kind of transition. And some people, they may forever stay in that picking stocks era because it is exciting. Like I said, you go for quick gains, you can keep seeing all these market bull, market bear, plus 10%, plus 5% a day, which is very boring for passive index, I know. But I feel that the fundamental is always needs to be learned first rather than, you know, just having that part ownership of something.
Okay, fair. Barring it becoming a full-blown argument,
Yeah,
I think both sides have already all sides have shared their point of view, and I think that's the interesting part of the episode, and that's the challenge of the space and the industry, because in this whole finance and personal finance space, everybody thinks they are right one. That's how they stand in the industry, right? But I think ultimately we are here to evaluate what are the things that have worked and what are the things that don't work. You know, of course, over the course of time, and there are definitely some assumptions and there are all sorts of things at play. So we are here to distill lah. Okay, so maybe for a start, okay, for all you busy professionals, any thoughts on what are some things that have aged out very badly? You know, like they don't work. Yeah, they just don't work. Wealth accumulation strategies.
I think I'm just gonna go and pick a low-hanging fruit
Yeah.
and say that crypto hasn't aged very well. All right.
This is getting personal.
Yeah.
But, for
Yeah.
context, Chris Ng has always been the boring guy doing the dividend investing at the corner, right? And then I think for many years he's been bashed, right? Like all the crypto bros were attacking him. It's like, hey, like blah, 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 blah. And then now you see whatever happening in crypto lah. So that is
Okay, but I'm open-minded about crypto. I mean, it can make a comeback, but at the moment, the momentum is not on their side. And that's not likely to happen for now. And I like to go really psychological or the mindset of a
this
crypto
is
investor.
not financial advice. Okay, this is not financial advice. We are
In
just
that-
trying to hear his point of view.
In
Yeah.
that when you listen to a young man and he says that he makes 20 to 30% from a particular trade, in the past, I would really ask, what led you to get into that trade? But these days, observing teenagers and the way they talk to each other, my question will always be, have you been looked down upon in your life? So much so that you needed that trade to give you that boost to your confidence and your self-esteem. And I think that crypto and the kind of bros that they managed to grab into the crypto world, and to be fair, I was sucked into it as well. When the Anchor protocol was giving 21%. And if you think about it, the Anchor protocol's 21%, the Terra ecosystem. It's really about your manhood and your value as a guy, your status between other guys in the hierarchy, and where you stand in it, right? And the people who do the most trades are the people who really see themselves as being dropping out. Like, imagine you see your friend goes into university, gets a banking degree, he goes into finance, becomes a finance bro, and then you ask yourself, what am I doing here? And then social media gives me all these negative messages about people doing well, right? And so now I've begun to have this generalized theory about it's not about crypto. It is about trading and really immediate gains. And things are not going to change. The industry is going to use these immediate gains to basically rope in the next generation of men, right? From Gen Z to Gen Alpha, to tell them that if you subscribe to my strategy, I'll give you status.
I understand what you mean. And those things definitely have aged very, very badly.
Yeah, very badly.
Over the course of time. Yes. Any thoughts? Like, what have aged very badly?
In my late 20s, I think when I started investing after I got my private degree done, I think I had like 10K and stuff. So the original thinking was to just go for dividend stocks because then I put that money, the dividend come in, they can pay for my internet. They pay for my mobile bill, my expenses go down. So I had that thinking for 2-3 years. And I tried that. Then I kind of realized after reading a lot more different blogs, I think we had quite a few blogs at that time.
Yes.
And I think I came to realize that if you have very little money, you don't have a lot, and you start your investment journey by just going fully in dividends, your wealth accumulation will be really slow because you're not going to see that trajectory because you're getting that payout. And for most of the folks that I talk to who subscribe to this idea, they are not even reinvesting the money they get. They are spending it like pay for internet bill. So then it's a question because if you're still in your 20s, 30s and you're doing this, then in your 50s, you might find that your wealth didn't accumulate the way that you would really want it to be. So then after that, I switched on to a full-on growth equity strategy that's just diversified, and then I carry on working. So that's the thing that I feel didn't work for me.
Didn't age very well. Okay. So maybe I have something to kind of like pair the few things, right? So I've been doing this investing thing for 8 years, 10 years, it's been a while. And I have never seen a thematic fund succeed. Yeah, in the past 10 years, and you name it, there was the cannabis, there was the robotics, there was the solar, and none of them have succeeded. And hear me out, right? This is my thesis. Oftentimes, the thematic funds, this is how industry thinks, okay? Oftentimes, the thematic funds appear after there's a rally, okay? So
because there's a market to sell.
Yes, because there's a market to sell to, right? So there's a rally of a particular industry. I think the hottest one back then was like the cannabis stocks, right? And primarily was because of the legalization and the whole bit in the West, right? And then there was so much media coverage and everybody incentive is aligned okay? And then you see this uptrend, big rally, and then the fund managers come in and say, how do we organize this thing to then sell it to the bigger funds? All the bigger investment houses and because a lot of them have investment mandates that doesn't allow them to pick single stocks. Okay, so they have to buy from funds. And so the fund managers would organize these funds usually at some of the highest points, of the rally. Okay, because there must be enough juice first, then people is like, hey, this one like can. So they set out the fund, they buy at the peak, and they charge you a super premium on the fees. Right? They are all north of 1%. Okay, these days maybe like got 0.8, 0.7, but your index funds are going at 0.03, 0.02. So relatively it's like how much? Like 40 times, fees compared to their usual funds that they run. And so high fees is gonna be your negative burn, in the things that in the investment. And most importantly is they oftentimes are entering at a high lah. Right. And then the industry will go through a correction. As with any other, like growth cycle, right? It goes through a correction. And half of them never ever comes back. Right? Or they will come back at like subpar, in what they sold you at. So I legitimately have not seen any thematic funds that work very well. I know I am bound by my sphere of concern. So maybe the K-pop funds have done very well. I don't know. But I'm always very cautious when someone comes to with like this big trendy idea like this fund. Yeah. They don't age well lah.
I totally agree.
Totally. Hey, never shoot me. Yeah.
No, which supports my thesis for early investing because I got burned by biotechnology funds in my 20s.
Okay, fair.
So
fair.
I got burned so badly.
It could be worse. You could have gone and studied biotech and not get a job there.
Oh, that's even worse. I agree. Totally agree. Yeah.
Fair. So we're done there already. The argument is over already.
Yeah,
So, I get it. But
I'm just
I think
poking the bear.
yeah. I know. But thematics really haven't worked out too well, I think, for a lot of people. And the thing is, what we are trying to say here is these things will come back again in another form. It always comes back. That's the whole industry. So you want to accumulate your wealth, you must be shoot and shot that, okay, people are going to do this. But not everything is wrong or bad, but it's just, you must understand the base parameters, then you know how to like guard against them. Yeah, that's my point of view. Yeah. Anything that aged very badly for you?
So I'm going to take it more holistic. I think that staying loyal to your job is going to age very badly. This is something that
It
I
has
have
already aged very badly.
but I have said this like the past 3-4 years. And back then people were still like, we are still going through the great resignation wave. What have you? That time AI is still not that mature yet. So I've been mentioning this on my channel many times. I'm not sure how many people took action, but it really all stems from that scarcity mindset. Like, okay, everyone only has 24 hours to live, right? So we only have 24 hours, like we only have 8-hour working days. Some of us have OT. But the fact is that we are trying to make our money work faster or better for us. That's why we look at other strategies. Like we want to get rich fast from crypto, want to get rich or consistent income from dividends. And we lose sight of how much we really want to grow our wealth. And the fact is that some of us invest so much time in our job, building relationships, networks, and all this. You come to a point to realize that the companies don't even care, right? I mean, 3-4 years I talked about this before. Some people still don't believe, but the fact is the company would cut headcount or restructure or even move their operation centers to where they deem fit. And now it's not only all these cost pressures, it's AI pressure, right? They are cutting headcount left, right, center, all over. And nothing is going to stop this. It's going to get an increasing trend, okay? And all these thematic ETFs are banging on this, right? Right now we are in a memory super cycle. We are in an AI super cycle. And
New terms. Yes.
All these things are just supporting this whole narrative that companies really do not care about you and your loyalty. So if you are still in that old mindset that you should give your all and retire in your 50s or 60s in this company, if you're that fortunate enough, I think that this mindset needs to be changed and it's really outdated for a few years already. But if you haven't had that mindset, this is really the time to wake up.
Okay, fair. So what about some things that are a bit more like tangible, right? Like let's name names. Let's go there, let's drop names and all that, right? So I think over the course of many years in this space, you see different movements, you see different ideas pop up. And I think it's good to do a bit of a stock take on how valid they are, right? And then how things have evolved, right? So I think one of the biggest movement, in this period is the 1M65.
Okay,
right,
that's good.
Yeah.
Isn't
Oh,
it 10M65
Yeah,
now?
I know. It's
Ching,
more and more. Right. So just so I'm clear, right? I do know Lou, right? And we've chat multiple times, but the number keeps moving, lah, right? So
Right.
so that is something. But for all of you that don't know, 1M65 started as a movement where you will use your CPF system to accumulate your wealth, and then like eventually at 65 years old, you will be a millionaire and more lah, right? So now got 4M65, whatever lah, all sorts of stuff, right? But it actually in some ways run counter to some of the ideas here, right?
Right,
Where
definitely.
yeah. So just want to like take a stock take on that. Like what is your
So
point
for
of
me,
view?
I'm a fairly long time friendly critic. I mean, I see myself as a friend of Mr. Lu, but I'm very, very critical of 1M65. And I think the reasons I have are not particularly complicated, right? In that if you want to put everything into CPF, you'll be subject to policy risk. And I've been talking about policy risk even before they eliminated the CPF special account at the age of 55, which is essentially a rug pull of 1M65. And I guess that's something that I think Singaporeans would just need to be aware of. But I'm not saying that there's any maliciousness from the government perspective, because I was telling people that if we can extend everybody's lifespan by 3 years, your CPF life payouts need to be adjusted downwards by the actuarial scientists to ensure that the payouts are sustainable. So it's really nothing bad about the whole system that might turn against you. So yeah, I think policy risk is the number one thing you need to think about when you're
because you're
looking at a
concentrated,
1M60.
right? Yeah, in the
1M65
1M65 idea, you
right.
are concentrated in the CPF life system, right? Which just want to be like echo whatever Chris Ng say. I got a lot of Chris, okay, yeah. What Chris Ng say, right? I don't think the government began thinking I'm gonna rug pull the 1M65 guys. No, right? They have come out and talk about the whole idea of liquidity relative to yield and all that, right? I think that's a different discussion. We probably had it somewhere, we've had this all the updates across the industry. We have updates. Just look through the library, you'll find something somewhere, right? But the whole idea of policy risk is when you move one part of the policy, end up you kena lah on the other side lah, right? So I think that's there is some level of validity there. But anybody got other comments?
Maybe I'm best to speak from 1M65 perspective because I am quite aligned with how the CPF system works, right? So having reached full retirement sum in special account by age 30, that was in 2021. It was even before all this fiasco come in, right? So at a young age, I was already like zooming on this CPF thing. And there was a fundamental reason behind this because the investment vehicles wasn't that mature. We do not have all these low-cost trading platforms. We do not have all the digital advisors providing products for you to invest your CPF or your SRS. So the landscape back then was very different. But look at all these trading platforms and brokers that we have today. It is fundamentally very different from what we have 10 years ago already. So the landscape has changed, which means the narrative would have changed. If I were to put myself, my younger self in the current landscape, I can honestly say that I would not have zoomed in so much into CPF because that was back then a scarcity thing, like I really limited lah. Then I look at the stock market, all this.
Jialat lah.
Yeah, jialat. Back then. And avenues to invest in the US market back then wasn't that as mature as now. So I would say that the CPF worked well back in my point in time. But if we bring it back today, we have so many more avenues to invest, so many more alternatives. So there is a need to really go and identify what are you truly good in and what are you truly passionate about. And CPF can still be one foundational cornerstone. This is what I still feel. But are there other alternatives to look at? So don't just be a single point of view, you cannot accept other people's opinion. There can only be one answer. No, there can be multifaceted answers based on different perspectives.
Okay, fair. Very PC. Love it. So then the countervailing point is ultimately I'm trying to find a place to manage my money, right? So if not CPF, then where, right? So you end up finding yourself using like or at least in recent times, and I want to move the topic to this, right? In recent times, there have been, of course, the rise of the robo-advisors, lah, right? Your stash away, your endowas, your Scythe, your whoever, whichever, lah, right? I think they are the three surviving ones, right? Then everyone else has it's like either new entrants or have balik already, right? So and they have in some ways kind of like changed how a lot of people are managing their money. The other day, my mom sent me a screenshot on like her portfolio and I was like, huh? Since when?
Your
right?
mom know how to use
Yeah,
endowment.
since when you're on this thing, right? The marketing people doing a good job, right? So, but you know what I mean, right? So, but I always have a little bit of a qualm with like, if I can see the underpinning composite of the portfolio, and I know that the fee is 0.02, why do I pay 0.5 on management, right? So to me, that has always been a little bit of my thing with some of these robo-advisors lah. So just want to get your stock take on how is the robo-advisors, like are they valid strategies and that whole
Okay,
bit?
so why not I jump in first?
Okay.
Because about part of the reason why I can walk away from my corporate job, right, is because I use robo. So your question is valid, right? If I can see what exactly is the portfolio, what ETFs, what funds did they buy, why can't I just buy myself, right, and save that fee? The way I want to think of the fees at that point of time is really about I'm just paying this fee so that they can automate it, and then I just focus on my job. Like this money would just be deducted from my bank account, invested. I don't even have to do anything in the robo advice. I don't even go to a platform. They just happen. So that's the way I make sense of the fees that I'm paying. Because at that time there's no easier way to just invest your money.
I think till date, if that is the basis, right, that means there's some automated system that will kind of like do that. Till date, there is no easier way.
Before robo-advisors came to Singapore, there are a couple of books published on robo-advisors in the US. And the primary reason why people invest in robo-advisors is that they enable this thing called tax loss harvesting, where I take a equity loss in the markets, I use an algorithm to switch to another equity with a very high correlation, and I report the loss. So robo-advisors were very effective to assist American taxpayers in reducing their tax liability. But when you port this technology to Singapore, we don't have a concept of these capital gains taxation, which sort of eradicates their utility for many of the local investors, right? So that's one. The second one is obviously the cost that you talked about. And the third one is we really need to ask ourselves very serious questions about whether our robo-advisors are profitable in Singapore. Because if they're not profitable in Singapore, you can expect a certain amount of changes as to maybe they might nickel and dime you, increase their expenses every now and then. It hasn't started yet, but they're not going to go on and lose money to help you manage your investments forever.
I think so far the three leaders, I think it's a fair statement, the three leaders, which is Saif, Endowas, and Stashaway, they have chosen the path of like outgrowing, like a scale, with
Other markets, or
scale in
like-
other markets, so that they manage the margins lah. But I know, I've heard.
Like you
But
say, well,
that
I've
one I
only
cannot
heard,
say.
right?
I've
We
heard.
can't
I've heard.
say specifics.
Yeah. But yeah, I think that's a fair point lah. Essentially, when I look at them, any thoughts?
Sure. Okay, so before the age of robo-advisors, we already have like human financial advisors
Mm-mm.
who are charging like 1%
Okay, so you
AUM,
take
right?
that narrative lah. Okay,
Okay,
okay.
right.
Relative to a human, this is chipua cost.
No.
Right? Yeah.
Hear me out.
Okay, yeah.
Okay, so why do human advisors still exist today? It's because there are certain group of people who really cannot see financial numbers. They are really uncomfortable looking at it, but they know they have to invest, which is why they trust the human, the branding, the professionalism of a licensed financial advisor. So they are willing to pay 1% AUM fees to them every year, even though they know that it is above the market, it is very expensive, and yeah, it doesn't make sense at all. But they just cannot see the numbers. They really are uncomfortable. There are people like that outside of the financial realm. I think we all have to acknowledge that. So after that, it transitioned to digital advisors or robo-advisors, like the three big players we have today. So it transcends to the younger people who are more mobile savvy, internet savvy. They can do their own, pick their own portfolio and all that. Okay, they don't like to talk to people, introvert people. Then they look at their mobile phone. Okay, I'm going to pick this portfolio. I'm okay with the returns. I'm okay with the fees. And yes, I'm just going to let it automate for it. I also don't like to look at financial numbers. I just like to look at returns. So that's the second stage. And then the final stage is where you realize, all these fees don't make sense. I can do this myself through a low-cost platform that automate RSP, DCA, all that stuff. And that's when you will evolutionize, from a human financial advisor to a robo-advisor to do it yourself. But all these 3 stages still exist in the current point in time. Why? Because they cater to different products for different people, right? So I wouldn't say that robo-advisors are a thing of the past. I think they will still continue to exist to cater to different target groups.
Yeah.
So this is my stand.
No, fair. To be fair, I don't think they are a thing of a past. I think they are a thing of a future.
Okay.
Right. And I think there lies the magic, right? Okay, we will talk a little bit about our views on the wider investment market in terms of the market itself, but I think there's one other thing that I want to kind of expound a bit, which is that at this point in time of the evolution of wealth management in Singapore, right, everybody is eating everybody's pie. Like you see the robo-advisors, they also have brokerage services now. Right? Like
They
and
hire people
integrated.
now.
Yeah. And integrated into the app, right? And you see the brokers also entering the so-called structured products kind of space, right? With RSPs and with whatever, right? And then you also see like you just and you see the banks, even the neobanks or the digital banks, they also embed investment features very directly into their platforms these days, right? And every one of them will engage us to try to tell you why they are different. But candidly, ultimately, a lot of them are providing very, very similar features and very similar. And similar is an understatement. Some of them are outright same. If you look behind the funds that they are buying, you look behind the breakdown, it's the same fund, right? So I think there's something to be said about like how these products are kind of like eating into each other, and how do you then evaluate like it's low cost, it's low fees, the sole parameter, of deciding which platform to use when you're looking at these fund management platforms. Any thoughts?
I think the reality is for those companies that are competing, right? One is you probably see who has better marketers to brand that message so that people think they really are different.
So wait, then the question is, right, so there's these dynamics in marketing, right, where if you spend a lot more in marketing, you have to transcend that cost into the product, right?
Correct.
You translate the cost into the product in some ways, right?
Yeah, but now marketing is not just the marketing that we know.
Okay.
We're also talking about product marketing and better user experience. Like in the past, when Chris is doing investment many years ago, he probably will have to go through every single transcript, read every single thing, look at the report, all that stuff. But now with all different animals, brokerages,
Your Moomoo, your
work,
Webull.
the work is a lot easier because they summarize it for you. The transcript is a lot easier to read. I think some of them in the past I even attended like earnings calls just from the app. Also, it just makes life easier.
Okay.
So then, if you are choosing a broker that makes your life easier, I don't think it's wrong.
Okay. So then cost is not your sole measurement in because the word on the ground would definitely be like cheapest, right? Who's the best? Who provides the best? But like I said, everybody provides very similar things.
I mean, everybody will probably the cost will always keep going down anyway. It's just what new features are they putting in.
Okay, fair. Yeah. Any thoughts?
I'm not exactly cost conscious when it comes to brokers because it's very
Because
commodity.
he's done.
Because it's very commodity.
It's true.
It's very commodity,
It's true.
right?
Yeah.
Yeah, I think for me, just a sense of history that maybe they've been around for a while, reliable, easy to set up. That's good enough.
But Chris is also one of the few people I know that still uses CDP.
Yes, I'm notorious for that.
Yeah. No, but
I'm
I think
notorious
the wisdom from there, from Chris Ng, right, is that ultimately the platforms are the platforms, right? Like they will create features, they'll create ideas, they'll create things for you, but at the end of the day, it's still the investment thesis at play, right? You're still picking, you still gotta pick something that works, right? And it's a different level of pickings, right? You can go all the way from the single stock or the composite portfolios all the way to managed products. They're all providing you different things, right? And in some shape or form, it is a commodity, right? But they will try to create new things and new features, to try to highlight themselves. Yeah. So any thoughts?
I have.
Yeah,
Okay,
because
so-
he has dealt with all of them.
I do. Which is why I'm quite qualified to talk about this.
Yeah.
So I'm a cost-conscious person, and I believe a lot of you watching TFC are trying to choose the best platform, the most optimized one. But I think that's something that people overlook is that the market access. Okay, do they have market access to the products that you want to buy? Okay, everyone knows US stocks, Hong Kong stocks, maybe even Singapore stocks, right? for that matter. But are there other markets where you want to get exposed to? So I think this is where different brokers may have different market access to where they want to buy. And it's very important that sometimes you feel that you like to use this brokerage because of their features, their UI, their UX, but it doesn't provide the product that you want to buy. So there's a mismatch. But you don't have to be limited to just one broker. You can have multiple brokers and it's all free anyway. So you just sign up them for the welcome rewards or whatever. And this is essentially what they want. They want conversion. They want user numbers, daily active users, monthly active users. Yeah, so you fulfill that front first. But at the end of the day, you need to realize that what's the product that you want to buy. So other than just cost, you also need to look at FX spread, market access, and how reliable is the platform. Has it been over at least 10 years in the market so that there's some sort of compliance and
10 years is a bar, right? I think in the past few years, there are many, many new things, right?
So I think these are just some factors that you should consider other than just cost.
Yeah, I think when I first started investing, it was IBKR and then like TD Ameritrade. Think or Swim, which is already dead already. And they put out the market here, right? I think it's Canadian, right? It's a Canadian broker. They put out the market here. So I already entered the my investment era was already past the Kay Hian, past the Kim Eng, past all of them already. And when I used like IBKR and TD, right? And then I looked at like some of my other friends using all those other bank type, trading platforms, right? Like, this UI is horrible, But then, a few years later, all these new animal brokers come in, and then my friends look at me and say, hey, your UI is horrible. Because relative to like IBKR, TD, all these guys, and then you have all these other newer brokers that are entering the game to then kind of keep providing. But the dynamics doesn't stop, right? They in order to capture your business, in order to keep you as a client, they will always innovate. They'll always have new things, right? Low fee, no fee, margin spread, FX spread, new integration to whichever market. And then it's a arms race, right? Is that a fair
You
statement?
know what's the latest arms race?
What's the latest arms race?
Having physical offices.
Yeah. I hate that. Sorry.
I was in Hong Kong 2 weeks ago, right? The number of physical retail brokerages so much more than Singapore.
Yes.
Every
corner at Tsim Sha
Wow, it's
Tsui,
not just
Thong Lok
one
Wan,
or
you turn, you see all of them there. I hate that. I've been telling the Mumu guys, the Long Bridge, hey, relax, really, like this is just gonna eat up into your cost. It's gonna make it so expensive for you to operate. Then who my tan and I my tan. The clients have to pay for it, right, in some shape or form. The KPIs don't make sense.
But the REITs investor will be very happy. Yeah. Someone will fill out the occupancy gap.
No, and then because they can afford, right? So you already see in the late stage, right? In Hong Kong specifically, it has priced out a lot of the other retailers, right? Because these guys can afford, right? So that's a different discussion. So like all this innovation, they are always there. They always come up with new things. So and then I think recently the latest one is like Webull, right? They came in with the first in the market, dynamic RSP strategy, which essentially allows you to kind of buy into the market periodically, but then adjust the volume that you buy based on the price that is in the market at that point in time, right? So the theory would then be to be able to so-called get better value over the course of time, because that's what RSP is about, right? You keep regular saving plan, keep accumulating. Then there's this dynamic RSP thing that allows you to accumulate more when the prices are down and accumulate less when the prices are up. So that is essentially like a new automated feature that they are trying to do, which is interesting. But like I said, there will always be new features coming into the market, right? It never ends. This thing that never ends. Yeah. But any thoughts on this?
Okay, so let me start, right? So the normal RSP is that we have a fixed frequency, we have a fixed amount. So it could be like every month you receive your paycheck, you dedicate $1,000 per month into your specific ETF or any other index or stock that you like. So in Chinese, we call that 定期定额啦. In English, it's just RSP, right? Regular savings plan.
Love it.
Okay, but the truth is that some people may find this a bit too boring. And
boring doesn't mean it's bad, right?
Boring is not bad. To a lot of us financially...
Our first 15-20 minutes, like, boring is good, long and short of it, right? Boring, tested, proven is good.
Yeah. But the truth is, some people, they really want to seek excitement. Some of you, I also understand you really want to see those kind of gains and take part in whenever the market goes up or down. So dynamic RSP kind of works in a way that when the market goes up, you buy less, and when the markets go down, you buy more. So you're kind of like trying to take advantage both sides. Of course, it doesn't mean that you will always be profitable. What it means is that you're just taking advantage of the market movement. So like in trading, we call that the 200 days moving average or something. So you follow like a moving average thing. If it falls below this moving average, you will try to buy more. And if it goes above, you buy less. So essentially, you are trying to be more wise with how you DCA. Is that a right approach for everyone or not? I certainly do not think so. Some people are better off with a regular DCA and not trying to time all these market moving averages. But the fact is that some people, they may like this kind of strategy. So this is where Webull Dynamic RSP would be a great tool, especially for this group of people.
Essentially, there's something to do with this dollar value averaging thing, right?
Mm.
I mean, it's not totally like because dollar cost averaging, I would believe if you listen until now, you get it already, right? You broadly already know. It means just accumulating over the course of time and then like buying cheaper and cheaper as it kind of like essentially just accumulate consistently, whether it goes up or down, right? Dollar cost averaging, where it goes down, then you average it out, right? So that is the broad idea, right? Is that a fair statement?
Actually, what's very interesting is that I think even 20 years ago, there were various financial texts after they discussed dollar cost averaging. They theorize a better approach called value cost averaging. And VCA,
I've been asked multiple times on
is
this
exactly what I think the dynamic RSP is trying to do. My view is mathematically is a good thing, but I would caution that maybe you apply it for example, global equity, a broader ETF, where there is mean reversion. Overall, there is this long-term uptrend. That probably makes more sense.
I think there's 2 points I want to add, because I also agree with that, because my journey is just basically RSP, right? You just put a fixed cost every month.
I love how that's your journey.
Yeah, my journey is
Yeah, my journey very
boring.
simple one, right? I just
Yeah.
RSP until I retire.
Yeah. Or you RSP until you realize that the money that the company pays you don't make sense anymore. Then you don't work. But the reality is we've gone through a few different market crashes,
Yes.
recessions, bull markets, right? So we also know, I think for most of retail investors, the psychology is when the market goes down, they will hold back and not say invest more, because they scared that they're catching a falling knife and it goes down further.
Yeah.
So if you go with an automatic approach like what Webull is doing, probably is one way to invest more when the market is down.
Yeah, probably. I mean, it is. That's the whole
Without having
mechanics, right?
to
Without having to
do
decide,
anything,
right? It's
yeah.
automated. You turn on the feature, right? So,
Correct, but that said, I think it's also worth noting that the Webull feature is not something like you turn on and every single portfolio becomes dynamic. You get to choose.
You get to choose
what
you
is
want.
dynamic
That's what
and
I
what's
heard,
not
yes.
dynamic.
Yeah. Okay. Interesting. But ultimately, you still need to boil back down to your investment thesis, right? So whatever features that any company has created, whatever new latest hot products, everybody will make them sound cool and sexy, right? That is the first principle of the industry. But if you wind back everything, it's still your investment thesis. It's still how you look at the markets and how you position yourself within the broad market, right? So that's kind of still ultimately where things are. So maybe in closing, I just want to get a sense of like where everybody is when you're looking at some of the big things in the stock market, right? Because there are 101 markets, we cannot go through everything, right? But in the stock market, do you have some thoughts around like how you look at the current market? We're not here to profess what is good, what is not good, but just get a flavor.
I think right now we might be in the middle of an AI correction that started on Friday. And that's very, very interesting. And the correction in Singapore is actually much smaller than the US. So I am looking at in my view, the worst asset class at the moment. Real estate investment trusts have not gone up a lot this week. And I absolutely like these laggard kind of asset classes, right? Nothing has changed.
I love it.
Yeah.
Like I have been putting more in those, right?
Right.
Because I see the distribution yield being very stable, and because everything is down, so you get yields of like 9%, 8%, 6%, like a lot of, and it's not just like your small weird names that are giving you this kind of yields, it's because it's been so sold down. So many of them are trading price to book at such a discount, right? That is reflecting in the yield that they are giving. So in some ways, right, they're paying you 6, 7, 8% to wait for like reversion, you
Right.
know, or like for the market to so-called like revalue them and price them like properly lah, in that sense, right? So I totally agree with you. I've been accumulating on that front. Yeah. I've not said it publicly, but yes, I've been accumulating on that front.
Great
Yes.
minds think alike.
Yes, if not, how to be on the show, right? So, yeah. So we are only one corner of the internet. You must remember, right? We have selected the people. Yes. Any other thoughts?
I mean, like wealth accumulation across the generations, just be patient and you actually get rich faster if you're willing to get rich slowly.
Okay lah. Okay, I let you sleep. I let you sleep. Usually this type of rubbish I'll call out. But it's not wrong lah. I probably get it. But okay. Let's just give Chris a slack. Yes.
Because I'm fundamentally not an income investor. I'm a growth, and index investor. So I would disagree with what Chris Ng just said,
No
but
worries.
I will not challenge him because I believe that everyone has their choice to
yeah.
choose their best and preferred strategy. And even you as a viewer, you're watching this or you're a listener listening to this, you will have your own strategy that go towards. But what is more important if we look at the current trend is that don't panic because the market correct 4 to 5%. Always be in the market. Don't try to time a market crash by going in and out because that's the worst mistake that any rookie investors could make. Of course, you could say that you time perfectly the peak and the bottom, but how many times can you do it consistently? And there will be people telling you they have been doing consistently for how many years, but what is the track record? Is there fully verified sources? And if they can really do so well, do they really need to sell you the course or the training program that they do? Yeah, so be very aware that such things will happen in a bull market, right?
Take the cost providers again. Okay. But actually on that note, right, then how do you square it with like the dynamic RSP?
Yeah.
Because technically you are timing the market,
Okay.
right? In some shape or form. Yeah.
Okay, so dynamic RSP in this case, because I would say that some people, they really have itchy fingers. They know they have a standard RSP or DCA going on every month already. But sometimes they may have some excess cash for whatever reasons. Maybe it's part of their dry powder or, they just keep some cash somewhere. They know, the market dropped 4%. Nasdaq 100 dropped 4% on Friday. Is it a good time to enter? Should I add in more? And if you don't like to make that decision manually or you cannot make that decision manually, maybe that's where the dynamic RSP setting comes in because it's automated. You don't have to decide. So the beauty of RSP is always that you have this decision, but when you want to click the buy or sell button, you cannot execute. And because it's human emotions at play, okay? So human emotions is quite different from what we are mentally prepared to do. So there's always this option to consider. Of course, it's not prescriptive. Whatever you do, just make sure it fits your own risk appetite.
Okay, but truth of the matter is, in some ways, you are timing the market,
Is
right? Yeah, because you are trying to you're trying to buy more, or at least the system is trying to buy more when the market is dipping and buy less when the market is going up. So you are not timing the market in a traditional sense of like you are still investing every month, right? It's still regular, right? You're still another time in a sense, but you are sizing your bets, based on what is doing well, and so there is some level of market timing lah, ultimately, but I think the value part is the real discussion lah, right? So that is that. Okay. Any thoughts? I just RSP law, that's it.
Yeah, so
That's it.
I don't even RSP now
So
because
I'm done.
because for people who don't know, the bulk of us don't run a business. We are work optional. We choose what we want to do now. So we don't have a regular salary to do
be
any
regular,
RSP
yeah,
anyway.
Okay.
So actually what I'm looking at right now, I'm actually more on the thematic side. I do have a feeling that robotics will make a lot of sense from the different research that I'm hearing. But like you said, it's taking a lot more time to research.
Yes.
But
yes.
I think most people shouldn't have to even consider about thematic investing
Yeah.
for now.
Okay.
Until they have a decent portfolio.
Okay. So maybe I right size my argument, right? From whatever I've said in front, thematic funds don't do well. I am very certain on that. But there are times when you can find industry gems, where and then those companies can ride through the industry. Okay? So in that frame of mind, you're trying to find the winners.
I think we also need
Right?
to size because we can your statement is a bit broad, right? Thematic funds don't do well.
Yeah.
But I think it's also maybe for how long? Because
Oh yeah, after a while, then they become another theme lah. Right,
Because
they're not hype lah. So I think okay, maybe just
Yeah.
for context, I think a lot of the hype ones don't work. And then if it's an industry theme, then it is.
correct,
It
but
is
you
just what it
probably
is,
also wouldn't hold those thematic
Yeah.
portfolios for a long duration.
I would like to think that there's no conflict because I think me and Reggie, we are anti-thematic investors. We look for something that is already down, that is not popular, that people are making fun of, and
It's true.
buy it.
Yeah, I'll
That
tell my
is-
edit team to write it.
That is itself, that is thematic.
Yeah.
That is thematic.
not wrong,
right?
not wrong. No.
Yeah.
But I'm a discount hunter.
Yeah.
Really, I just don't waste my effort on like lame discounts like miles.
Fair.
So that's a whole other shit. Kind of worlds. I don't do those things. I
Same
think
here,
those things are a waste of your bandwidth. I know we can have that discussion next time, right?
Is that why we don't have this kind of clients on
we don't
KFC?
because I don't believe in it. I think it's a waste of time, right? Because if you have limited bandwidth, I would rather put my bandwidth on what I'm good at. But I know Chris has
So have you flown business class yet?
so I am flying tomorrow.
Oh, well.
But I know Chris has an argument around like if you're not very good with this investment thing, then you automate that part lah, right? And then you can focus on another game that works for you, which for some people would be this mouse game, right?
And you choose what game you want to play.
You choose what game you want to play. So that is that. Okay, but I'm giving validity to this bargain hunter energy
Yeah.
that I have really put all that energy into like where's a good bargain in the markets, right? Like I'm looking for assets like a cheapo. Like I go Daiso, find the best corner like that, But just so we're clear, essentially, I think we have laid out how and this is a curated bunch. Okay, like different people use different methodologies, different investment ideas, and I think I wanted this episode to have a stock take on where the industry is, how the industry have evolved, the different platforms and the investment themes that are out there in the market today, right? So I hope that this then provides all of you a quick rundown on whatever that's happened in the past like 8 years, like all the things that have changed, and from there make better decisions in your wealth accumulation journey lah, especially as busy professionals. So amongst all the kerfuffles and exciting discussion, do you have last words, for our busy professionals that are trying to accumulate wealth?
Keep trying, work hard.
Don't give up.
Don't give up. There's no such thing as failure, only feedback.
I hate him, oh my god.
It's okay, I'll tell my editor to all put in big captions later.
Oh my god.
Oh, I cannot.
Okay. Is that what you're gonna end with? I will let you fly. Okay. Yeah, Chris.
Okay, mine is very simple. Show me the incentive and I'll show you the outcome. Because a lot of us, even the panel's discussion today, or whatever product providers that you have, or the people that you're working with, they all have their own single incentive, which is to sell you something or network you to something. So be clear of the incentive first. Some of it can be positive, some of it could be negative. You just need to make sure that whatever that you're making your decisions on align with what you believe in. So that's my take. Show me the incentive and I'll show you the outcome.
Okay, fair.
I think probably what people should also know that there is no such thing as free. Whenever people tell you that there's no cost or it's free, you can do this, you can buy that, I think at the underlying that they have to make money somewhere. So either way, they will make money off you. So don't just be swayed with the idea that this thing is free. It's not free. It's just packaged in a different way.
Yeah, fair. Okay, so maybe my closing thoughts is after doing this thing for like close to a decade, I have come to appreciate old wisdom more than anything else, right? So I like things that are time tested. I like things that have been around for a long time, so I hate to be in the new section of the bookstore. I like to go and dig the corners to see like, why is this book still in print, right? And I think that kind of thought translates into the way I look at investments, look at decisions, and look at business structures, because I do think I have a little bit of an advantage because I run a business, right? And I've read like a lot of all these different investor reports and all this. I eat those prospectus for breakfast, so for me, I think I have a little bit of an advantage in that, and I like the ways that have been done for a long time. Yeah, not that new ways don't work, but you are taking a premium on something that's uncertain. Yeah. So
And you don't have to be the one to prove that it works.
Yeah.
Let other people prove it.
But then if it works, you get the alpha, right? If it works, you get the alpha. So you choose your game ultimately, right? So yeah, with that, I hope you had a great session today. Thank you all. Thank you all the
Yeah.
Chris's. I've been cornered by them today. Very happy. And if you like what we do visit thefinancialcoconut.com to put your email address so that we can reach out to you for our next event, our next launch. We got 101 things that we're doing. Meanwhile, take care. See you next week. Bye-bye.